Hey guys, welcome back to the Greenback Voyage podcast. This month, our special podcast is discussing about the 2008 financial crisis. Now, most financial institutions, most economists, most of the world generally knows what happened with the entire financial crisis. The CDOs, MBOs, synthetic CDOs, which were basically the catalyst for all the market drop-offs. And then not only that, we had Lehman Brothers collapsing, AIG being merged, Bear Stearns offering the massive drop-off in early March. So I wanted to kind of get your guys' opinions. We have both Joel and Krishna on the call with us today. And I kind of wanted to get your opinions about this kind of crisis and what you think could be prevented in the future for this not to happen again.
So Shravan, when you look at the premise of the issue, right? So you have a bunch of banks, deregulating on mortgage-backed securities, right? The mortgage market is booming. You have a lot of banks who are happy with that boom, so they're investing in it, and they're bringing in their clients and customers also into these mortgage-backed securities, right? And each security has their own respective ratings, which a lot of people blindly trusted. But I think the biggest issue that we saw that caused the crisis was not necessarily the CDOs and synthetic CDOs, but the lack of trust because of the falsification of ratings, right? So you have all these mortgage-backed securities that people think are AAA rated when they're actually not, and they have a bunch of subprime loans hidden in them. So people think that they're buying into the most secure part of the United States when they're actually buying into a bunch of sham loans with rising interest rates in the subprime market. And that kind of just collapsed when everyone realized what was going on. So I would say when in the future, it's really up to federal power to make sure that certifications aren't falsified.
Right. I think we come a long way from what happened there. We have passed a lot of laws to prevent that. And if you look at like the derivative that they made, the CDOs, most of them are. It's kind of like a chain of a lot of things that went wrong. So you have your AAA equity, your AAA mortgage bonds that people were buying into, and then you have the subprime and the really junk bonds that no one buys. And basically what the investment bankers did was they would put those, they would put the triple B ratings and some of the AAB rating, the mid class bonds in with the triple A's, and they'll make a margin on that. And it would just go down. So they would put the triple B's with some of the C's, and then it would just go all the way down to the junk bonds. And that once the junk bonds started to fail, it just started to trickle up, and that's how we had the whole collapse with the CDO market. Go ahead.
And if you really look at the way the banks were like framing these bonds, right? The moment in certain situations they were taking absolute junk bonds, like we're talking about C and B rated bonds, right? And they would take a decent amount of them, like a couple 100,000, merge them all together into a single mortgage-backed security. And if you have a single C rated bond, that's considered a risky investment. But what if you have a pool of just C and like B rated bonds? What's the probability that all of them are going to get defaulted on at the same time? Not very likely, according to the bank logic at the time. So when they merged a bunch of low rated securities, they kind of classified it as diversified, and it's not risky anymore, and they'd up the rating to like double A, which is ridiculous because if you look at it, it's a chain of events where you have absolutely junk bonds just collapsing one on top of each other. Putting them together is not going to make them any less junk. And that's where the banks really messed up.
I don't think it's really the problem with the, rating the securities itself. The problem was the investment banks paying off Moody's, S&P, and I'm forgetting the third name now, but paying off those rating agencies just to make sure those underlying securities within those MBOs and the CDOs were actually AA or AAA. But the thing was, when they sent it off to the CDO division to like kind of make up those bonds and send it off to the investors, those CDO managers didn't know what the actual ratings on those bonds were. They knew they were crap, but they didn't know exactly what ratings those bonds would be, whether they were in the C territory, B territory, or just a single A territory. And that was the main issue there. There was a huge disconnect between each of the divisions, and it all came into one because everyone thought that everyone else was taking on more of the risk, when in actuality, the entire population as a whole was taking on the risk.
Right. It's also another thing with banks that are giving out loans. So basically, a lot of these brokers, what they ended up doing is using preying tactics to rope in customers who wanted to buy homes. A lot of immigrants, predatory tactics. Like a lot of immigrants who want to buy homes, low income members who wanted to buy homes, and they would give these, really, really, bad loans or mortgages. And that also, had a very negative effect, and that all accumulated into what happened, all the defaults that happened, in 2008. So it's a lot of things that went wrong everywhere, and that's how it ended up with the whole collapse.
It was honestly like a cycle of bad credit card debt, because you had a bunch of like low income individuals, like we're talking the bottom 30% of America, who also wanted in on this bubble, right? That there was this massive bubble, everyone's like getting a home, and the bottom 30% wanted in. And at the time, it seemed possible because the banks were so high on the profits that they didn't care about people defaulting on loans anymore. They just wanted a high supply of mortgages so that they can pump more mortgages into securities and pump up their ratings, because they didn't care about ratings, right? They could pay off Moody's. They could diversify a bunch of junk bonds and get ratings up automatically. They didn't care about ratings. All they needed is a constant supply of mortgages, so their mortgage-backed securities continue to exist, and there's always demand for those at the time, right? So they would just rope in this bottom 30% with extremely bad like APRs and really bad like procedures. So they didn't the bottom 30% didn't know what they were doing. They just bought the house because they were happy.
It wasn't even bad APRs. It was they had ARMs, which is basically adjustable rate mortgages. And the problem with that is interest rates started to increase after, I think it was 2005, from about 1% all the way up to, I think in '08 it was around 5.25, 5.5%. And the problem with those ARMs is, while they seemed very low at the time when most people were buying it in '05 and '06, by the time they got to '07 or '08, and those one-year contracts kind of expired, do you guys know how hybrid ARM kind of works? It's so it's kind of like, let's say you have a mortgage for 5 years, say for example. So the first year or the first 3 years, they'll have that set at a fixed interest rate. And then after those 3 years, they'll have it like 2 basis points above whatever the current interest rate is. So as interest rates started to increase, those people had to pay more on those mortgage principal and interest payments than they ever had to before. And they kind of didn't know what they were signing into, which is, I guess is what you were talking about, Krishna.
So it was just it was just like a general cluster of uneducated individuals trying to financially free themselves. It was also simultaneous like fraud from banking institutions paying off S&P and Moody's, right? So we have falsification of certifications. We have bad ethics from banks while devising these mortgage-backed securities, which led to a chain of bad CDOs and bad synthetic CDOs because they're all dependent on those mortgage-backed securities. And we after the adjustable rates kicked in and skyrocketed, we saw a massive surge of subprime defaults, and that collapsed. After a while, you can't you can't scam your way out of a certification the entire time, right? You can't keep paying them off. Someone will catch on eventually, and the population did, and we saw the worst crisis of for time. It was literally a massive scam by banking institutions. It wasn't even like a financial crisis. It was a financial scam.
Right, and the really thing that hurts is like all the investment bankers kind of saw what was coming, right, and they ended up shorting each other's positions, and that's just really amazing to me. They would buy all these derivatives and credit swaps against their own position, or they would do it on another investment banker's position, and they would end up shorting themselves to protect themselves from what was coming.
That is
So
true.
they ended up saving themselves, getting a government bailout, and eventually the people who get hurt is always the American taxpayer, and that's the tragedy of what happened in 2008.
Yeah, because under no circumstance are the banks truly gonna lose. Like, sure, we saw Lehman Brothers like collapse completely. Their stock price hit zero because the people caught on, but the government just bailed them out, right? They were acquired. So, and the similar thing happened with Morgan Stanley as well, and a lot of other banks. For example, Merrill Lynch got acquired by Bank of America at discount rates. So at the time, these companies, even though that they were failing, weren't really worried of failure because they always know that the government's like going to bail them out. It happened before in 1991. It happened again in 2008. And if it happens in the future, the government is always going to back the financial institutions. So there's truly no fear of getting caught for fraud in our economy because there's always someone to back up these financial institutions, which is truly boosting a negative attitude.
Yeah, and the main issue wasn't really, I don't think there's going to be any problem if we just kept to MBOs and CDOs failing. The main issue was, those insurance agencies like AIG and all, having credit default swaps, as well as, providing synthetic CDOs so that they could get in the game as well, which, is a main issue because I'm pretty sure, like, that entire kind of industry of, like, the mortgage buying industry went from like $900 billion to 62 trillion within a year and a half. It was just basically money on top of money on top of money based on one underlying security in itself. And if you think about it, the only people who kind of figured out that something was wrong was really the bankers that were issuing these.
It was a horse race with a sick horse running, right? The sick horse was the mortgage-backed security, and you have bets, and then you have bets on bets, and then you have more bets on bets. So when the horse turns out to be sick and just dies in the middle of the race, the economy's fucked.
But I kind of wanted to ask, Ben Bernanke, he was a very strict guy in terms of, I guess you could compare him to Gary Gensler and how he might act with the S&C in the future. But Ben Bernanke, he was very strict on making sure that investment banks and the financial corporation was regulating the markets properly, and there's no sort of scheming stuff happening. And a consequence of that was he issued out warnings to all the banks in the summer of 2008, because even then in the summer of 2008, there was a small crisis, but it wasn't global enough yet. But he issued a warning to banks such as Lehman and others, where he just basically said, you don't have the capital necessary. You need to raise capital if you're going to survive this crisis later on. And, Lehman CEO at the time, he didn't believe him. And, well, we know how the story goes there. But that caused basically the crash from September to around, I'd say, till March of 2009.
Yeah.
And it kind of, going off on that, with the recent, induction of money that's going into the economy by the Federal Reserve right now, do you think that consequence of seeing how they only had $600 billion in assets. It's not even as much as, say, Blackstone. But do you think, the Fed now is just scared that something similar might happen? And that's why they're injecting as much funds as they can into the economy to make sure the stock...
I mean, the system is very different, because the one of the fundamental differences between the 2009 crash and the coronavirus, and its, caused financial effect, right, is that one was circulated around one fraud, and the second thing is insurance, right? So in 2008, even though there was a lot of shady things happening in banking, a lot of these banks, whatever derivative they came out with, whether it be CDOs or synthetic CDOs, always had insurance on these. For example, Goldman Sachs, every single time someone took out a credit default swap from their bank, no matter the investor, both sides would be insured. So their mortgage-backed securities themselves were insured, as well as credit default swaps of the customer. So because of that insurance, a lot of people weren't really scared because they were going to get their payout even if the system fails. When it comes to the pandemic, it's not really a financial failure. It was more just a natural cause kind of collapsing basic basic workflow in the entire economy. So you have the manufacturing sector completely collapsing, right? And then because of that, you have the tertiary sector not working to its full capacity because they're all, quarantined at home. And because of that, there's no really insurance that's coming into play. Like, there's no insurance against people's income, right? If you're unemployed, you're unemployed. In 2009, it was the banks who were taking most of the losses, unlike now, and they had insurance. So the two events are very different. So the Fed pumping money might be just to, raise overall demand in the economy, but what America needs is more demand in the economy so we can restore to a previous boom.
Right. Now, even now, I mean, today we just passed the $1.9 trillion bill, which is giving out $1,400 checks to everyone, and a bunch of other, I think, unemployment benefits are extended till September 6th. With bond yields rising and investors expecting a recovery by summer, what's the point of injecting a almost $2 trillion back into the economy? I mean, we're already fearing inflation at this point, right? But unemployment has dropped to 6%. I mean, if you looked at the unemployment numbers last week, we expected around 200,000 new jobs created, but it ended up being nearly 500K jobs created. So the economy is coming back naturally. It's recovering, yet we are now injecting another $2 trillion into the market. I'm very wary of a long-term or prolonged inflation that's about to happen this decade.
Yeah, that's kind of the side I was taking. Just kind of, is the Fed kind of overreacting just because, this is also unprecedented times. We haven't really dealt with a pandemic of this size since 1920, and you could probably even say going back to the Black Death era. So, is the Fed kind of overreacting just because of the previous two crashes? And 2008, the SPY fell about 48%, if I'm guessing right. And it took about 4 years for the market to recover there, and millions of pensions, insurance funds were lost during that time. And is the Fed just trying to make sure that that kind of doesn't happen again?
In my opinion, I would say that the Fed injecting money into the economy is not necessarily a bad move, because if you think about what's happening, right? There's a renter crisis right now in the United States. So you have a bunch of people who were in the renters market and renting housing, and not a lot of this population was in the upper income bracket of the United States. They're like kind of floating around the poverty line in the United States, which is like slightly below $40,000 if I'm not wrong. So you got a population that really can't support themselves that well, and they depend on rent, the house that they're renting. And then all of a sudden, because of unemployment, they can't afford this rent anymore. And because of the stimulus check, they're able to afford this rent. But what happens when the market recovers and they have to start paying rent again, right? And unemployment ends. And you also have the government, giving like rent relief to people where they don't have to pay rent for a certain amount of time. So they're not paying the rent for that time because they're unemployed, but they're not going to magically get a job as soon as the market recovers, like immediately, right? So then they're going to have backlogs on rent. So that creates like a whole new real estate crisis, which kind of needs stimulus to offset it, right? Because if I don't have money, well, when the market recovers, I can't pay my rent.
Right. I mean, even if you look at what's happening now, I think there's going to be a lot of jobs that will go, they're going to be completely wiped. So if you look at what's happening with, office buildings, everyone is going remote, right? So there's not going to be the need for janitors or, maybe, people, secretary at desks, things like that. So maybe they'll go online, but especially janitors, when schools were canceled, when people went remote, those people suffered huge unemployment, and it's very very likely that this will continue, and there will be a complete huge job cut for jobs like these. So for unemployment to drop back to like 3% or 4%, I don't think that's going to happen for a long time. So a lot of jobs are going to stay. A lot of jobs that were lost are going to end up being lost forever. But with the rent problem, the thing is, so yeah, people who lost their jobs and unable to pay rent, and a lot of the government did pause rent. So basically, they said, you don't have to pay it now; you can pay it later. But all that will be accumulated. It's not like your rent's canceled. It's just it's going to be. It's just going to be pushed away, and what about your landlord? He or she is also going to need the money, right?
Yep.
So it is kind of a domino effect of what's happening right now in real estate. But if you look at the consumer spending data, it's still continuing to go up, right? People are still spending, and people are still spending money, and the economy is still slowly recovering. So yeah, the people with low income household are getting affected a lot, but I think the economy is still recovering, and it looks like this low income group is the one that's paying the cost, and that just seems like the same thing that happened in 2009, and same thing is happening now.
Joel, I kind of want to say something about that. So I want to circle back to a conversation that we had earlier, where I was talking about how studying economics is not ideal because most economics you learn is theoretical. That kind of applies when it comes to spending data. So sure, it's in theory, in economic theory, increased spending in the economy boosts demand and therefore kind of recovers the economy to a previous state. But in this situation, most of the spending is not organic like it's supposed to be. Spending should be classified as debt-based spending and non-debt-based spending. Most of the spending that's happening right now, a lot of people need to do it. It's out of necessity because people need to buy things to survive this pandemic because there's already an upset economy out there. And a lot of the spending is funneled by bad credit card debt, unregulated loans from loan sharks in the below the poverty line. The middle class is struggling to live on the same level of luxury they used to previously. So because of all these lifestyle changes that the middle class and poor of America are facing, and which is funneling inorganic spending, I would say that when time comes for this debt to be paid back, it won't be able to be paid back, and that could lead to a whole another crisis, right? So we have divergent crises because of this pandemic. We have a upcoming renters crisis within real estate. We have an upcoming demand crisis when it comes to inorganic spending. So we have multiple pathways that this pandemic is causing that can really collapse the economy once again. And
right, I mean, people are racking up their credit cards, right?
Mm-hmm.
That's primarily what's fueling spending right now. But I mean, what I'm trying to say is, if you look at let's say Apple, we take Apple and their iPhone sales, they had a record beat in terms of sales. So people are still buying iPhones during this time of crisis. But yes, I mean the low income household is getting they're suffering a huge a disadvantage here. But if you look at the bill itself, the $1,400 checks, there's a lot of sections in the bill that has spending towards other countries. So if you look at even the last bill, the $900 billion bill that was passed under Trump, a billions of dollars went to Israel's IDF force for missiles. So the politicians here are ending up not putting priority to the Americans here, and yeah, go ahead.
All right, I think this might be a debate for another time. I wanted to focus more on, I guess something Krishna brought up with, I guess, government intervention. So in the '08 crisis, I mean, how much did we spend in the end? Like 425 billion to bail out the banks.
I think more than that.
And then I'm guessing, at least I think those were around the official numbers. And then around $800 billion for the stimulus bill that was passed in 2009, 2010, somewhere along those lines.
Yeah, about total was about $1.5 trillion spent during the 2008 crisis.
Yeah, so I guess my kind of thing is, what areas do you think the U.S. government should step in and say, we're going to solve this? And what areas do you think the U.S. government should just leave off and just let the way of markets dictate what happens?
So
the first thing is
the 2000.
Go ahead.
Okay, yeah. So when it came to the 2008 crisis, I would say the government was right to intervene and bail out banks, because the financial institutions do need to stay stable for recovery, right? Because at the end of the day, even though the banks kind of scam the people need to go back to the banks in order to take money out, put money in. On a very fundamental level, the banks are necessary to even maintain demand, right? And so the bailout was justified, but you can't bail out every single bank. And
I wouldn't say it was justified. I mean, it was a necessity at that point.
Yeah.
You had to bail out, otherwise you would collapse the whole financial system in this country, and that's what the bankers are betting on. I mean, they were doing this knowing that they'll get bailed out, right?
Yeah. And that's why it's literally up to lawmakers to strengthen regulation on fraudulent behavior. So the only way you could have prevented a crisis like '08 was prevent fraud, and that's something that the government really needs to focus on and strengthen laws. I mean, sure, they have been doing it since '08, but it's not completely foolproof. It can happen once again because there's a lot of new derivatives that are coming out in modern markets. Like previously we had mortgage-backed securities. Now we have a whole world of electronic derivatives that we can bet on, and that can create a whole another chain of bad financial events. So every single derivative
But I think
needs to have some
See,
sort
the
of
government
that is kind of
the government now should focus on monopolies. So a lot of small businesses out there, including in the IT and a lot of spaces, are suffering the worst right now. And big companies like Amazon, Microsoft, they're still enjoying their revenues up, their profits are still up, and they're starting to consolidate the market here, and they're slowly starting to eat up the market space the market share that small businesses are starting to die out. And this is going to lead to this is what ends up happening. I mean, if you look at the last year of government donations and lobbying, Facebook and Amazon still tops the list, right? So as larger these companies grow, the more and more influence they're going to have on our policy. So that's the primary focus that the government should focus on, is monopolies, because the monopolies is the end of capitalism, and it looks like we're heading towards these huge companies getting larger and larger, and that's something that we should and the government should focus on.
And if Chamath actually, Chamath did mention that currently the U.S. government, and not just the U.S. market, but the global market, is essentially, according to him, governed by 150 corporate members who have a seat at the top at the table, right? And these 150 individuals, all billionaires, have the power to control legislation. They have the power to change laws because of the amount of capital that they have and funnel into the government. And if we leave our fates to this 150 individuals, it's going to get dangerous, and there needs to be some sort of regulation to kind of compress corporate power. Like, we need to see a situation that happened with AT&T in the past. Like, Bell Labs grew so powerful that it had to be broken down into multiple like chains, right? And that's how that gave birth to AT&T. And that happened to BlackBerry before in the past. We need some sort of like breaking down of these businesses.
See, AT&T, even after the breakup, they have actually grown much stronger than they were. And even in
And they bought out most of those companies
right,
that
so
were broken
yeah,
up.
so they're actually bigger than they ever were before the breakup. And even
Yeah,
in
so
2008, right, all the banks that merged together, they're also stronger than ever. So that's the thing that, you know, government should and the more powerful they get, the more spending they'll do on lobbying, and that's the thing the government should focus on right now. I mean, it probably is too late for that, to be honest.
Yeah, it is kind of hard when you think about it, because every time we create new legislation, I mean, someone out there is going to figure out a loophole within it, or some new technology is going to make it like, you know, you can get around with it and still do the same thing without exactly breaking the law. I mean, let's take Formula One, for example. So every few years, the rules change on how you can design a car, right? But the thing is, you can't really know everything that a team will think of to come around with the loopholes that'll make their car go faster. And while it may look legal, technically within the rules, it's not illegal. And it's kind of the same way with banks. I mean, I know, Krishna, you talked about with electronic derivatives now, especially with crypto market on the rise with Bitcoin and all.
That's definitely dangerous.
But it's kind of hard. Yeah, it's kind of hard to regulate that without kind of knowing it's there in the first place.
Oh, it's not.
And the only
it's
way
not
to...
difficult. It's impossible, especially in the crypto market, because the whole premise of the new crypto market is deregulation, right? Decentralization. That's kind of like the basis of the budding financial market. So if you when we're talking about regulation, it's close to impossible. But I'm just saying, if we want to really prevent backlashes and you know, loophole exploitations like in 2008. Regulation is necessary. I'm not saying it can be done. I'm saying it should be done, even though it cannot.
Yeah, I don't think it should be based off Congress, though. I think maybe the FTC and the SEC should maybe.
I really
up with
think
their
there
own
should be some
regulatory loops.
international like body for finance. For example, we have the UN for peace, right? Like global peace and military, like, you know, control. But what about finance? Like, a lot of the global market is connected, and how do you prevent big banks, which operate on a global level, to commit errors like that happened in 2008? You need some sort of global body to regulate these. So we can't just rely on the SEC. We need some
that's
we need
true.
some,
because it is a bit difficult, especially with Joel. You were talking about monopolies, right? And I think one main reason, which I've talked about in the past, that, you know, the FTC doesn't want to kind of demonopolize these huge corporations that we have now, is because of the foreign markets. What's threatening the U.S. economy right now? I mean, we got China, we had Russia back in the day. Who knows what new players might be popping up and threatening to, you know, change the way the U.S. economy was in the past. So yeah, Krishna is kind of right in that thing where we do need to have a regulatory body that maybe controls the world. But then I guess you also have to think China is more communist, America is more capitalist. Communism isn't really focused on the same ideals of free market as capitalism is. So yeah, I mean, it will take a bit of work to kind of know if there's a right solution to this.
And the worst part about these companies, right? I'll make one last point, Joel. Sorry, but the main issue with these companies is that all of these companies, sure, everyone, me, my mother, my grandmother, all of us know that they're monopolies, right? But on paper, they're not. most of these companies have like subsidiary firms. Like IBM has like multiple chains of businesses that are different units and technically have a different business identity and are not affiliated with the original IBM logo. But we all know that they are, right? So on paper, they're not monopolies. They're like 20 different firms. Same thing with Amazon. They're like 30 different firms. They're a conglomerate of multiple firms. So you can't even penalize them when it comes to regulation in terms of monopoly. You can't even classify them as that on paper. So it's almost impossible for lawmakers to really tackle that problem.
See, here's the fundamental beauty of capitalism, right? So back like 10 years ago, Exxon was like the largest company in the world, right? Oil was, it was the biggest industry. They were controlling Congress. They were the biggest lobbying, body in the whole world, right? And now the guy Elon Musk comes around with Tesla, and he's challenging the whole effort. And now he's kind of forced everything to change. And is anyone talking about oil? Everything's about EV now, so it's kind of a huge disruption, right? So there has to be some kind of huge disruption that comes in from a third party. As far as government regulating, I think that's very, very unlikely. It has to be some third party guy who comes in and changes the whole system. And we see it with Elon Musk, and we'll probably see something new happen with big tech. So
Yeah, maybe something in fintech.
Yeah,
right.
honestly, we really need to see some educational changes as well.
Right.
We need
Even
to
if we
see
go to
like a-
fintech, right? We have blockchain technology coming in, and we have Bitcoin. This is kind of disrupting the whole space, right? So that's just how I guess the cycles go with an industry that grows so powerful like the oil industry, and then it gets taken down. And maybe the financial industry and the tech industry it's already so big right now, and maybe 10 or 20 years down the road it will be taken down by some other industry. So I guess that's how things will go.
And we
Maybe Jamie Dimon was right. Maybe Bitcoin might be a good threat to our financial institutions.
it's a very big threat. In
Yeah,
fact,
yeah.
the whole concept of decentralized finance is big banks' biggest nightmare, right? Because the whole business model is based on accountability and the trust that the people have in the big banks, right? Let's be real. If you gave all your money to Goldman Sachs to invest, you would be pretty happy because you trust in that big brand name, right? And you trust that they will get you the returns that you want. But let's take away those big brand names, and all you have is people governing other people's money, and that's a whole new landscape, right? It's scary. So the big banks they're frightened because now if we take away their power completely and everything's decentralized, right? Not only can they not scam people, but the people control their own money. So
Right. Yeah, that's the whole thing with cryptocurrency, right? It's giving control to the market instead of an institution. So that's a huge threat to what the financial industry right now. So we will probably see some major revolution in the financial world in the next 10, 20 years
yeah.
as we start to adopt cryptocurrency.
And
I think it's inevitable.
I would not be surprised if banks honestly utilize new technologies to kind of repeat what happened with mortgage-backed securities, and it's already happening with certain cryptos. Like if you take a look at USDC, if I'm not wrong, that's the cryptocurrency that kind of tracks the US dollar, right?
Tether, right?
I think that's what it is. The ticker is USDC. I think, yeah. So essentially, that coin is like kind of like a mortgage-backed security for the U.S. government, for the U.S. currency, right? And it's tracking it. Now, let's say that we've seen J.P. Morgan accumulate a massive amount of Bitcoin. We're seeing the Miami state government adapting a massive amount of Bitcoin. So let's say financial institutions kind of start making crypto-backed currencies because it's such a strong market right now, and a lot of people are predicting a future rise in technology. And the same thing with mortgage-backed securities happens with this because it's all based on certain premiums. For mortgage-backed securities, it was more the interest rates, right? For cryptocurrency, it's more based on the premiums that the cryptos trade on. So if they make securities like that in the future, then we're giving our power back to the big banks, and a crisis like '08 might happen again using this technology.
I see what you're saying. Yeah, I mean,
Yeah.
even I
All
think the
right.
latest report was Goldman Sachs is opening cryptocurrency to its clients. So now they're going to be trading cryptocurrency like Bitcoin, Ethereum, on clients' behalf. So a lot of investment banking the industry is getting on the hype train on cryptocurrency.
And the thing with most of the
All right.
population is like, even though like cryptocurrency and new technologies are supposed to be decentralized in name, big banks are starting to become like a medium for that. And because they're a medium and a lot of people already trust them, they're going to continue affiliating themselves with that name, even to trade crypto.
Yeah, and China is actually starting to mine a lot of cryptocurrencies under the government, and I'm pretty sure the U.S. government might be doing the same. But latest reports show that China's trying to assert a control or have some influence on the booming cryptocurrency market right now.
All right. Well, yeah, I think we've had some good ideas so far. Whether they'll be implemented, we may never know. We can only figure that out in the future. But I think just one last thought or a question before we go off. What do you think was the main cause of the financial crisis?
I mean, I'll go first.
Just one.
Just
one.
It's greed. It's greed in all areas of from banks handing out mortgages, trying to sell, give mortgages to people with low credit scores, with no background checks, just to make a commission on the mortgage you're selling, from investment bankers, shorting and basically having a full-on casino in the markets with derivatives. It's just greed. I mean, it's simply what led to this, what led to the 2008 crisis. It's just one word: greed. Yeah.
I'll be completely honest. Even if the government tried, if there was a second crisis to come, the same thing would happen, and there'd be no stopping it. It's just the underlying faults within our system that honestly can't be solved.
And that's the beauty of our capitalist economy. But I think my word would also be greed, but it would be in a different way than what Joel said. I think that the 2000 tech bubble really kind of catapulted this, because if you really think about it, people started realizing that you really need safe investments and profitable investments to put your money in. And mortgages seem like the thing to go to, MBS especially. And it was the thing to go to for many pension funds, insurance companies, and so on.
I mean, what can go wrong with the
because
mortgage,
of that,
right?
yeah, and that was the thing then. But then, yeah, once that started, it became like the tech bubble again, where people tried to turn that to making new profits, even though they weren't really profitable, and that ramped up everything. And yeah, that eventually caused one of the biggest crises that we'd ever had.
Like after 2007, mortgage growths weren't even organic. They were completely funneled by junk bonds and just massive supply of mortgage securities with no background checks.
Yep. I mean, if you look at house prices, they stagnated from the end of 2006 all the way to the crisis starting in 2008. So, yeah, I mean, even back then, people started to realize that there were people defaulting on their loans and the supply was catching up to the demand.
Yep.
But yeah, I think that does it for us. I don't know if you guys had any other last thoughts you wanted to say, or I guess blurt out about our financial institutions.
All I'm praying for is corporate America to really just get neutralized, because the way corporate power is growing, it is not going to be good for civilians in the future. It's a war zone, guys. It's a war zone.
And on that note, yeah. Joel, I guess go ahead. You have the last thought.
Yeah, just my fear is just, growth of monopolies and big tech and big corporations getting more powerful, taking out the small guys in the market and gaining more and more influence on the government and our public policy. So that's just, the thing I fear. But I think, maybe everything will correct with the new cycle of disruptive technology. And that's kind of the hope with EVs taking on oil, blockchain and cryptocurrency taking on the financial industry. So I guess we'll see what happens this decade and I guess this century.
And on that note, thank you guys for listening in. If you're watching on YouTube, make sure to hit that like button and subscribe. If you're listening on Spotify, just make sure to follow us as we post out weekly market updates as well as monthly specials. And we will see you guys next time.